All right, welcome back. Thanks again for watching. If you haven't subscribed, please do so below. So in this video, I'm going to walk through S Corp basics, right? I'm going to keep the video under 15 minutes. I'm going to first go through 4 slides, just kind of going through the mechanics of it, what you need to file. And then at the end, I'm going to walk through an actual S Corp tax return to kind of show you the flow of the numbers and how that impacts your personal return. If you have any questions, leave them in the comments below. Thanks again for watching. All right, so I'm going to go through 4 slides and then I'm going to go switch to show you what the S Corp tax return looks like and the flow of all the numbers and how it impacts your personal return. Again, any questions, leave them in the comments below. So first off, what's an S Corp? So in simple terms, it's essentially how companies are treated for tax purposes. So from a legal perspective, it's not really there is really no like S Corp. You can be an LLC for legal purposes, but taxed as an S corporation. You can be a C corporation, but from legal standpoint, but taxed as an S corporation. You can be a single member LLC, right, a disregarded entity, or be taxed as an S corporation. So it's kind of how you're being treated for tax purposes. Similar to setting up like an LLC or a C Corp, you're going to go to the IRS website, get an EIN. It's free to do. Make sure you open up a separate business bank account and you want to register with the Secretary of State in the state that you're doing business in or where you have employees. So this section right here, you would do very similar if you were opening up any other type of entity, right? Not an S Corp. So you would do the same here. The key here with the S Corp is you got to file this separate form, and the tax form is 2553. If you Google it, it's about 4 pages, but the first 2 pages is really kind of the meat where you kind of put your company name, the EIN, the shareholders information, social security numbers, address, when you started business. And then the last 2 pages, there's just like a couple like check boxes. But this is key, and it's due 75 days after you form your company. So just say you started your company on January 1st. This thing is due March 15th. Now, the IRS is pretty lenient on granting like an extension if you're late. Just make sure you put this on the top of your, on the form, on top of the form, just mark it in like red ink. And they'll kind of grant you relief. So keep this in mind. This is a nice little code to use. But this is the form that you're going to use to fill out. And if you want, I can create a separate video on how to complete this form. Some of the rules around the S Corp, it's limited to 100 shareholders, where an LLC, you can have unlimited. C Corp, same thing. You can only have 1 class of stock. Common is 1 class. Preferred is another class. There's preferred series A, preferred series B. All these are different classes of stock. In S Corp, you can only have 1 stock. No international shareholders. So if there's 2 founders, one of you are not U.S. based, you can't form an S corporation. And the owners of the S corporation are individuals. So you can't have a corporation being one of the owners of the S Corp. You can't have a partnership, an LLC, being owner of an S Corp. And we see this happen a lot where S Corps get formed, the founders kind of use an online, one of these quick set up a business, and they don't know all the rules. So this whole S Corp, it's kind of defunct, for lack of a better term. So it's really important that you work with a really good attorney to kind of help set you up here. Here's another important thing regarding S Corps. So owners of S Corps, before they can take any distributions, they have to pay themselves a reasonable salary. Now you may ask, what defines a reasonable salary? The IRS doesn't give numbers, but they kind of state, all right, given the industry, given the size of the company, revenue, is what the owner paying themselves reasonable. So, and we see S Corps get audited all the time because of this. So this is like numero uno if you're going to focus on anything, where the S Corp, revenue $1 million, but the owners paying themselves $50,000 and they're taking distributions of $300,000. That's just going to flag you for an audit, and they're going to ask you, why are you paying yourself so little for a large corporation, large S Corp, $1 million. So you got to be very, very careful on this. you don't want to take distributions before you take a salary. You always want to take a salary first. And the owner doesn't have to take a salary. They just can't take distributions. So the owner decides, all right, in 2023, I'm not going to get paid, no distributions, no salary, no, that's fine. They're not going to get dinged for that. It's just when they take distributions and no salary, or they take, or their salary is very low. That's where the IRS is really kind of focused here. All right, next up, accounting software. So we've talked to many prospects. We've talked to many companies where the owner says, oh, our business is very simple. I kind of manage it all on Excel or Google Sheet. And I ask, oh, show me your balance sheet. They don't have a balance sheet. And you got to, and these are businesses that are, north of $1 million, or they're getting close to $1 million. We see this all the time. Excel, Google Sheets, nothing against them, but you're running a corporation, right? You got to be serious about this. And signing up with a QuickBooks, a Xero, or a Wave. Wave is free, right? That's an online accounting software. These two, $30, $40 a month to run your business, send invoices. That's pretty inexpensive. But you got to have a balance sheet. You got to have an income statement, and these tools will kind of help you get there. Payroll, like I said, with the owner's salary, plus if you have employees, the one that I like for small businesses is Gusto. It's great. The pricing is black and white on their website. I really, really like it. The user interface is great, integrates well with Xero and QuickBooks. Tax due date. Remember this. So tax return due date for the company, for the S Corp, is March 15th. It's always March 15th. And if you're not ready, you want to file this form 7004. It's a one-page PDF. You can Google it. All you do is you put your EIN on there. You mark the box that you're an S Corp, put your address, and then you can mail it in if you're not working with a CPA. This will buy you another 6 more months. Okay. So again, March 15th, just don't forget it. And then this tax basis. This is also important with S Corps. And the reason why it's important is the IRS, one of the advantages of an S Corp is that the owner can kind of take distributions, and those distributions are not subject to tax. But if your tax basis is below zero, and I'm going to show you an example of a tax basis schedule, if it's below zero, those distributions that you take could be subject to tax. Most likely they are. And what they want to see now, and this started last year in 2021, is if you're an S Corp and you're an owner, on your personal return, the IRS mandates that they see this tax basis schedule. So again, I'm going to show you this tax basis schedule, but this is very, very important. And you want to work with your CPA to monitor this basis calculation. All right, last up, just some other items. I created a video on W-2s and health insurance, because if you're an owner of an S Corp, you get health insurance within the company. You need to do one step before the end of the year. It's essentially kind of grossing up your W-2 in order to get this health insurance benefit. Next, the 7203, it's required on personal tax returns. This is that tax basis schedule. If you're S Corp, if you're paying contractors over $600, you got to file 1099s. And just my overall opinion on S Corps. So if you're just like a small business, no intention of growing or selling the company or raising capital, S Corp is fine, right? And you meet all the criteria as I talked about earlier. But if you're a startup and you're looking to raise capital, you don't want to start out as being an S Corp. It's just a big mistake. There's a lot of issues and a lot of like tax perks that you're missing by starting out as an S Corp. So again, if you're a tech company, you're looking to raise capital, funding, just don't start out as an S Corp. But if you're just a small business, it could be a lifestyle business and you're growing, right? You could be a $5 million business. And it's pretty simple, and S Corp is okay. So now I'm going to go into, walking you through a tax return example of an S Corp. All right, so here's the last segment of this video here. So here's the S Corp tax return. It's Form 1120S. You're going to put, when the company was formed, the end date, your EIN, the date it was incorporated, and then the S election. Now that 2553 form that I mentioned earlier, you're going to apply for that. You're going to mail it into the IRS, and they're going to send you a letter back saying, congratulations, you're formally an S Corp. You need to keep that letter. And on that letter, it's going to say the effective date. So don't throw out that letter, and you want to keep it because your CPA is going to ask for it and all that. So that's one point here. And then essentially, I'm not going to go through every page here, but this is page 1. Essentially what page 1 does is it tells the IRS, all right, this corporation made X amount of revenue, and here are all their expenses. And then here's the net profit. Okay, so you got revenue, expenses, profit. And again, this is where if you're managing this from your QuickBooks file, you can create this tax return, or you'll be able to assist your CPA on creating it very, very fast. So that's one thing I wanted to point out. It's, again, the S Corp doesn't pay any tax. Okay. You're just telling the IRS, all right, here's what our company did, right? We made $138,000 of profit. Okay. That's essentially the basis of this S Corp return. Now there's the balance sheet, right? And this is where I ask a lot of companies, show me your balance sheet. They don't have one. Balance sheet, I could save this for another video. But it tells you, your assets and your liabilities. So here here's how much cash the business has. Here's some other assets. There are no liabilities, but here's the common stock, the equity section. So you can see here, there's capital stock and there's APIC, additional paid-in capital. So remember, you can only have one class of stock. And if you're a corporation or an S Corp, you're going to have some type of stock here. So this is another kind of like important area. So here's the balance sheet. We covered the income statement. Again, informational purposes to the IRS, okay? Because remember, the S Corp doesn't pay any tax. Now let's move to the K1, okay? Again, this is all part of this 1120S, okay? So this K1, so you're probably thinking, wait, if the corporation's not paying tax, who's paying the tax? Well, it's the shareholders, okay? So I didn't put, here, Ferris, he's the shareholder. He owns 100% of the company. He has to report this income, right? Remember, the company had $138,000 of income. He has to report this on his personal tax return, on his 1040. And this form, this K1, is what is used, that he's going to use to put on his personal tax return. So again, this corporation, this 1120S, is going to create this K1. And if there's one shareholder, 2 shareholders, 50 shareholders, they're each going to get one. And depending on what their ownership is, this box number 1 is going to be allocated proportionally. So in this case, if there were 2 owners and they're both 50-50, you would take this 138 divided by 2, and Ferris is responsible for half of this, and the other shareholder is going to be responsible for half of that. Okay. So that's the main point of this K1 here. And then also this box 16 here. So we talked about distributions, right? So box 16 is telling the IRS, all right, this corporation, in fact, Ferris took $5,000 of distributions. Okay. So when they see this, when they look at his personal return, they're going to expect to see a W-2. If not, that could flag an IRS audit. Okay. And then the last thing I'm going to cover here is the stock basis. Okay. It can get complicated, but I'm going to keep it simple. So here's the 7203. Ferris is going to use this on his personal return. So, you got the basis, right? He started out, he put in $10,000 to start the business. Okay. So that adds to his basis. That's a good thing. Then he made income during the year, $138,000. That also adds to his basis. So before taking any distributions, he has $148,000 of basis. So he's $148,000 above zero, right? Above his basis. Then he took out $5,000. So now his basis at the end of the year is $143,000. That $5,000 he took out, he doesn't have to pay tax on because his basis is above zero. Now let's change the scenario and just say his basis was $4,000. He took out $5,000. The first $4,000 he doesn't have to pay tax because that $4,000 is above zero. But the other 1,000, because now he's below zero, he has to pay tax on that on his personal return. And this is exactly why the IRS wants to see this and why they require this starting in 2021. So you want to make sure this is maintained every year. Again, if you have any questions, I try to keep this entire video to 15 minutes. I went a little bit over. If you have any questions, let me know. Leave them in the comments below. Thank you.